On the positive side, the growth in the GDP continues to be resilient, continues to be above the global average, above the Africa average, and above the average for emerging markets, which is about 4.4. Kenya has grown north of 5% for the last couple of years, and the outlook for the period 2024 to 2026 still shows an outlook of about 5.2% on average. And this is a consensus outlook by the Central Bank Monetary Policy Committee, the IMF, and other independent players. So it's quite a positive, and it's driven by a number of key sectors. Agriculture has had 2 good years. The outlook for agriculture remains positive. Tourism has also had a good couple of years, and again the bookings and the forward-looking picture looks quite positive there as well. And within there, of course, there are sectors such as manufacturing and other areas where there have been challenges. Inflation at 4.3 is also well within the target range of the MPC. And you will remember this came down from about 9% just 1 year ago. And it's really the result of a lot of proactive work that has been done by the MPC, including some of the rates actions, the implementation of the corridor framework last year, which has really improved the way monetary policy actions are transmitted into the economy. And really, as an industry, we are very pleased about that, and this is something we have given feedback, positive feedback, to the central bank and to the governor. When you look at the CBR rate, in the last MPC meeting, there was a small reduction of about 25 basis points. It's an indication, it's a big signaling of the direction of travel for the rates as we look forward. And this is good news for customers of our industry. It is also good news for the industry itself because we'll be able to lend more, we'll see improvements in impairment, and it has a lot of positive indication going forward. On the other side of the equation, we've seen increasing geopolitical challenges in the world, impacting, supply chains, shipping routes having to change, increasing the cost of goods. We've seen sticky inflation in the US, in the EU zone, that has led to delayed action in terms of possible rate reductions by the Fed and other central bank authorities out there. We've also seen depressed consumer spending as a result of some of the economic challenges that are in play. We've seen some of the actions ongoing to address the fiscal challenges that we see in the economy. So overall, mixed picture, a lot of good going on, a lot of positive indicators for the economy, and some challenges within which we have operated as a bank. Now, within this environment, we continue to execute our strategy. It's dynamic. We have the strategic flexibility, strategic capability within the organization to continue delivering on the strategic plan that we have agreed with our board and with the group.
If you look at year-on-year, 318 billion back in June 2023, you see that number coming down slightly to 316 billion. I think what is important at this stage is we know very well it's a high interest rate environment in the country, and more so with also what has happened if you look at especially the consumer, the retail business, with the high cost of living picking up, especially when we look at the finance bill. We know some taxes that were increased, including the housing levy, And as a result of that, and looking at what the Monetary Policy Committee have been doing, raising interest rates, for the first time we saw CBR coming down in quite, if you have to look at it historically, that number has consistently been going up. This is the first time it's come down. So with that, we've seen a preference from customers, especially wholesale, and this is basically we are talking about traders, to go for facilities that are short-term in nature. So in here, trade has picked up significantly. Things to do with overdraft to support on the side of, businesses. And we've seen customers shying away on long-term borrowing, term loans. Those ones have come down. And so the numbers you're seeing here, slight drop, but as our MD is saying, gross lending within this period is 68 billion shillings. So while it shows a small drop compared to the previous year, the churn there is quite high. And it's simply because of what I mentioned, preference for short-term lending at this point in time. Tied to that, of course, we've also seen our mortgage as a product. That number has picked up as well. And then we've also seen secured lending also picking up during this period. I think it will be important also to mention that these numbers, you can see all of it is in local currency, but about 30% of this book is in foreign currency facilities. And so it follows, you'll recall there's a time, the shilling to the dollar was trading at around 160. This has come down, and effectively, then it means also the numbers get impacted, not because of the gross lending, but simply because of strengthening of the Kenya shillings, which then implies that the drop will be also higher just because of strengthening of the Kenya shillings.